Good morning and welcome to the Monday Call, brought to you by NZ Funds. I'm Stefan Clark, Chief Client Officer at NZ Funds, and I'm joined by Mark Brooks, Chief Investment Officer at the firm. Technology is yet again the place to be and driving markets higher, especially in the US. Our guest this week is Ivana Delevska, Founder and Chief Investment Officer of Spear Invest, an investment firm focused on capturing breakthrough trends in technology, and manager of the NASDAQ-listed Spear Active ETF, Spear Alpha ETF, an actively managed exchange-traded fund. Before founding Spear, Ivana spent years at elite hedge funds like Citadel, Millennium, and as well as Deutsche Bank, building expertise in identifying disruptive technologies. With that background, Ivana has built significant experience investing in some of the world's most innovative companies across the technology landscape. She has also featured on a range of TV shows, including Bloomberg TV. Spear Invest with a mission of being at the forefront of the next major tech wave, the industrial technology revolution powered by AI, cloud computing, cybersecurity, and data analytics. Welcome, Ivana. It is very exciting to have you here, and we've got a lot of great questions to ask you. We'll kick off with, if you don't mind, what brought you to found Spear? And so take us through a little bit of your background, and then when was the decision made and how did you go about it?
Well, thanks for having me, guys. I've spent the past 15 years researching and investing in industrial and technology companies. And what I've really focused on is finding opportunities across the value chain. So basically analyzing one sector or one area of companies and trying to figure out how that applies to other sectors or other areas. So in this case, I spent a lot of time analyzing where industrial companies are investing their CapEx and R&D dollars. And that's how I compiled a list of 20 companies that I believe are positioned really well for the next 10 years at the breakthrough of playing on some breakthrough technology. So basically, I manage this portfolio of 20 ideas, and I explored different things to do with it. So the ETF structure was particularly attractive in the US, where you could open the product up to outside investors. So that was really how I chose this structure and why I started it. But basically, the idea is that the past technology wave was really driven by consumer technologies, and we believe the next technology wave is going to be driven by B2B technologies. So that's where we are seeing a lot of the innovation come through and a lot of the changes, and that's where we're finding most of the opportunities.
Okay, and so the types of clients that invest in your vehicle, tell us about them. Do they tend to be retail investors, or is it across in other areas too?
Well, it really can be as broad as starting with retail to RIAs, to basically anybody that has interest or need in investing for the long term. It's basically like the product is a long-term product, and it's very concentrated, so it will be higher risk than most things that are out there. It's meant to be much more similar to a hedge fund strategy where you're constantly seeking alpha rather than providing a broad exposure, which is what most like indices or ETFs do today to a certain theme or a sector. So what we do is really try to dig in one layer deeper and find not only the themes or trends that are going to work, but also the right companies to invest in at any given time. So the investor base it could be a good fit for whoever is looking for long-term growth.
Okay. Artificial intelligence as a theme is huge, as you know, and it's reflected in your portfolio. Some say it's reshaping general computing into, I guess, one term is accelerated computing. How do you, at a really high level, how do you think about AI and the broad impact it's going to start having across the B2B landscape, but also elsewhere?
Well, we really see AI being a transformative force for the technology sector, but also pretty much every other sector, basically that can apply it and benefit from it. We saw this trend very early on by analyzing where industrial companies were investing. And then we realized that actually everybody was using NVIDIA GPUs, right? So as we dug deeper into the opportunity, we found out that there was a lot of breakthrough innovation going on, specifically with this transformer model that enabled AI going from being prescriptive to generative. So that's really the biggest breakthrough that's happened over the past 2 to 3 years, that now we can use AI not only to perform specific pre-programmed tasks, but it can kind of like think on its own. So that's really the big change. And now the applications are very broad. So the easiest or the early applications that we're seeing is in some of the areas where companies were already using AI for recommender systems. Like Meta is one example that they're using AI to figure out what ads to serve you, to places like search where we used to be able to, I used to have to do a lot of manual search, and now you're able to kind of come up with something pretty good, like with just one quick prompt. So those are just the early use cases that were already AI was already being used for in a prior form that wasn't as effective, and now it's just so much more effective and can really enhance these products. But over time, we see the opportunity set really broaden out to companies in like the pharmaceutical field can use AI to come up with new drugs, right? Companies in the industrial field can use AI to optimize their supply chains and productions. And back to what I was saying before, a lot of this had been already in the works for the past 10 years. It's just that the technology and the compute power wasn't really there to make it to a point where it was useful for companies to do this. And now with accelerated computing, a lot of these use cases are becoming actually able to deliver real results. So a lot of what we try to do is at any given point in time, we try to find the best risk reward opportunities, and the set is really pretty broad. Right now, we're finding a lot of opportunities on the hardware side and just the build out of the infrastructure side. Over time, there's going to be a lot of opportunities in the application layer. There's going to be a lot of opportunities in the actual companies that are using these AI tools. So we see the impact really kind of broaden, not just specifically for technology, but to other sectors as well.
Obviously, the hardware is critically important at the moment. Do you see some risks that the actual large language models become relatively just generic and the value dissipates from that space, that you get sort of separation of value?
Well, I think that is actually a real risk in investing in companies that provide large language models, because at the end of the day, they're very expensive to train and they're not that differentiated, especially over time. So I think when you're looking to invest, I think the easiest risk reward is in the picks and shovels, right? Where like that somebody's going to have to put this investment in place in order to train the models. The model layer of the opportunity, I'd say, is a little bit higher risk right now, just because you need to kind of keep investing as well, right? Like it's not like you can train a model once and that's it. You need to keep retraining these models and keep investing in order to provide value. So that's a layer of the opportunity where like right now, like Meta offers their own large language model. OpenAI obviously was the first one to bring one to market. But I think a lot of these players are gonna have a version of a model just because it's a way into the market, but then the money or the returns are really gonna be made more downstreams by the company, either like building on top of those models, tools and applications, or the companies using the models.
There's quite a lot of misconceptions around AI, around obviously what it is and what it's going to enable and what the, I guess, political and social implications for it might be. How do you think about what are the largest misconceptions that you've seen as an investor in this space, and also as a person who's, I guess, advocating for society to embrace it?
Yeah, absolutely. So I think it's very interesting because on one hand, if you look at it, things are developing very, very fast. It's almost at a level where it's scary. But then on the other way to look at it, it's actually like been taking us 20 years now to come up with something that is like somewhat useful or functional in the AI space. So I don't really see the risks as big as some investors or some people are advocating. I mean, if you think about it, we've been trying to come up with autonomous vehicles for 15 plus years now, and it's pretty incredible. Like, I remember the first time I saw a company demonstrate or demo basically how they were able to drive a vehicle across the United States on its own, like the vehicle drove itself, was in 2015 or 16. And since then, we've really made almost zero progress into be able to use this autonomous technology. So generative AI will help in this, right? So we're going to come closer, but it's not like things are developing at a lightning speed either. So I don't really see the risks, at least in the next 10 to 20 years that people are highlighting. I think it's really going to be more a tool that helps you do your day-to-day job, and it's really going to enhance productivity. So I think the impact is going to be really more positive on the productivity improvement side rather than I see some kind of a doomsday scenario.
As a reformed lawyer, there's a lot of talk of, in the professional industries, not just in law, but in accounting and in lots of other spaces, AI really impacting the way business is done and the way advice is given. Do you, and then that will obviously have significant downstream effects for how, for the employees of firms. Do you see the productivity growth having a meaningful impact to the way the workforce is structured?
Yeah, absolutely. I mean, even for my industry, like on the research side, I do see the research process being so much more efficient than what you would have been able to do before. So I absolutely see it being transformational for industries like that, where you can really use these tools and really like be able to like go through documents in a much more efficient way and come up with ideas and conclusions in a much more efficient way. So I think like those are the first use cases. Also on the customer service side, like those are, you really don't need somebody to be repeating the same information. It can be done in a lot more effective way, just through using a chatbot that can even give you like relevant examples. So I think like these industries are really like one of the first ones that are going to get impacted, but it's really going to be more positive than negative, because then if you're a lawyer, it does free up your time to do more productive things like critical thinking, which is something that AI cannot really do. So like if for a job like mine, like the value that I create is really in coming up with the differentiated ideas, right? And that's not something that can be really easily replaced by AI. However, a lot of the support work or the research that I need to do is quite labor intensive. So if you can streamline that, you can come up with a lot better ideas and a lot higher conviction or better research. So that's kind of how I see it on some of these industries like investment research or law and so forth.
It hasn't, at least it hasn't, AI hasn't become a common piece within the investment research market yet, that I've seen at least. Are you seeing any businesses investing heavily in AI to deliver more?
Yeah, absolutely. I think it's been actually a trend like that's been going on for the past 10 years. Even like if you think about the prior versions, so not generative AI, over time, like what companies have been able to do on the research side is a lot of this like going through transcript and sentiment analysis. So a lot of it, that's all of that is basically AI based, right? So like a document, if you look at it, like it can quickly tell you. And I think a lot of firms, like this is not what we do. We do fundamental research, but in some of the other areas of the hedge funds that I've worked for, they would use that for quant models, right? So I think it's been used quite a bit in the past, and now it's just the tools are getting better and better. And there is definitely some applications that were built using AI before that are getting kind of like more enhanced nowadays. So I think like companies that do this data aggregation or transcript aggregation tools, a lot of them are going to have to basically embed AI in their tools to be able to compete, because even like as a user, I follow a lot of these companies in quite a bit of that, and I go to a lot of the conferences and kind of like go to them as a user from a user perspective. Like even today, like I could build something that is a lot better than what some of these tools that I'm paying for are doing, right? So I think over time it will become embedded. Now the question is going to be who is going to be able to benefit and who is going to be able to capitalize, because a lot of the tools that are out there are quite easy to use. So if like I can embed it in my process, then everybody else should be able to do it, right? So I think the beneficiaries are going to end up being the companies that provide the tools that enable you to do this, right? So a lot of these data infrastructure companies where like you're storing the data there and they provide the tools, I think that's really going to be the ultimate beneficiary rather than the ones that are using the tools to build the applications, if that makes sense.
So that's a business like a Datadog or something like that, is it?
That's right. So Datadog, Snowflake, a lot of them are going to come up with tools that will help you like you put the data there and then they have an access to a large language model that you can pull from, and you basically like they have few basic tools that you can use to be able to build like easy applications.
And maybe this is jumping ahead, but you talked about yourself sort of being a fundamental based investor, and from what I've read, or I'll contrast it probably, a lot of technology investors at times have been very valuation agnostic. Ultimately, it's been growth and just really focus on growth. You clearly take a different view. How do you sort of marry that tension between valuation versus opportunity?
Well, valuation is a very important part of what we do. And the tech sector in particular is pretty difficult to value because a lot of the value does come from these companies delivering very high growth in the near term. A lot of people are saying, oh, the growth comes like in year 10 plus. No, not necessarily. Really, the key here is to figure out how much they can grow over the next 5 to 10 years, right? If they can show 20, 30, 40% growth, it's going to be a company that looks very different than somebody that's growing in the teens. So really, like if you look at the valuations for a lot of these high growers, they are based on the fact that these companies are going to be able to deliver solid growth in the next 5 years, not like forget about the next 10 years, right? It's really like they need to be delivering right now. So the interesting thing where we are today is that we are going through this economic downturn, right? So a lot of these companies, it's very difficult to parse out what's the growth slowdown due to the economy versus is the market getting saturated. So this is where we're spending like 100% of our time figuring out whether if somebody's coming up with a slower growth, is it because of the market or is it because their products are becoming less relevant? And sometimes it's also a function of both. We're seeing a lot of companies, because of the slowdown and the fact that companies started shifting their focus from growth to a little bit more cash flow generation. Some of them do have a little bit of a gap between product introductions, right? Because we are at this critical time where everybody should be coming up with new products, but maybe some are not able to do so. So that's really where we're spending the most of our time on, is figuring out, okay, the valuation is high, but are you really going to be able to deliver 20, 30, 40% growth in the next 5 years?
It's fair to say probably there has been a transition in that space, isn't there, where post-COVID or immediately post-COVID with super low interest rates, you ultimately had a tech sector that was very long duration. It was that 5 or 7, 10-year earnings, whereas the earnings were not that visible in the next 2 or 3 years, whereas now market is definitely rewarding businesses that can produce earnings now.
Absolutely. And I think there was also a little bit of lack of discipline honestly, during COVID, where people weren't even analyzing, okay, well, what is ultimately the market size here, right? Is it even possible for this company to be growing at 40% in perpetuity, right? So I think a lot of like some angle of it is actually like, okay, rates are higher. We are looking for more visibility in the next 5 years rather than 20 years, right? But there is also an element of like, hey, like you need to be a little bit more disciplined with your assumptions and making sure that they are actually, because at the end of the day, whatever you're assuming does need to play out for you to be able to realize the price, right? So whether it's in 5 years or in 10 years, you do need to have like the ultimate market size. And I think a lot of people just kind of weren't as diligent or critical in their analysis.
Yeah, makes sense. And I suppose at the moment it seems that, well, both within the very large end of town, the Mag 7, and even amongst industrials, there is an inflection in terms of capital expenditure. Businesses are coming back and starting to spend a lot more. Probably more within the AI space, are the extreme numbers from the Mag 7, the $200 billion of capex this year, is that going to crowd out other groups, or do you think it's actually a trend that we're going to continue to see where businesses are happy to spend?
So I think we are embarking on a pretty significant CapEx cycle. So whether the cloud service providers spend the money and then enterprises use those services, or enterprises start investing, we're going to see how kind of like what the mix or how that plays out. But in either case, these tools, this AI or accelerated computing that is getting introduced, companies will need to use it, right? So most applications will require you to have access to accelerated computing, and that just requires a lot of CapEx. So whether it's going to be the hyperscalers, or it's going to be sovereigns, or it's going to be enterprises, I think it's probably going to end up being a combination of both, or of all three. I think it's going to be a pretty significant CapEx cycle ahead. And we're just starting. Last year, it was really all focused on GPU processors. So NVIDIA was really the only company in our coverage universe that saw not only the hype, but then saw also the numbers, and revenues did go from 25 to 100 billion, right? So they did see the actual dollars flow through. This year, we are seeing it across the board in companies that provide all kinds of tools to the data center. So whether it's networking, whether it's chips and memory, so like inside the rack or outside of the rack, power components, thermal management, even energy and power generation. That's been a new area of focus for us this year. Those markets have been dead for the past 10 years, and even they're benefiting significantly from this investment. So in the first wave here, we are really seeing it mostly focused on hardware and physical infrastructure. And then as we go into the cycle, we believe these other tangential areas will benefit as well. But there is no question that we're going to go through a pretty significant CapEx cycle.
Obviously, the Mag 7 and within them, Google, Apple, Meta, Microsoft, so forth, are investing really heavily towards a capital expenditure. Who do you think currently has the lead, and why do you think that's the case?
Well, Microsoft for sure had an early advantage here with OpenAI, and I think they did a particularly good job with marketing their efforts. So it's not like Amazon was sleeping at the wheel, or it's not like Google didn't have the technology. A lot of these companies had been working on exactly the same thing, the transformer model, and spending time on advancing AI. I think Microsoft did a really good job on announcing the partnership with ChatGPT, something that was very easy for consumers to see. And now they kind of became the go-to for anybody building anything on AI. So they've been able to capture pretty significant market share. And I think they're the ones that are doing like in the lead for sure. Amazon has a lot of interesting things going on. It's just that they're a lot larger, so it's a lot harder to move their revenue base, but still like AWS grew 17%. That's pretty impressive. Not as high as Microsoft's 30%, but it's on that large of a base, it's still a very impressive number. And Google is the most debatable, I would say, out of the three, because they were the new entrant in the space, and I think they had the opportunity to gain a lead the way Microsoft did, but they somewhat dropped the ball, and now they're trying to catch up, and a little bit like of their business model is under attack here, with search being really something that's changing rapidly. I think they've done a good job transforming their product to be able to embed this generative AI. So now when you go search, it does look a lot more like ChatGPT than what it used to look before. So it's a little bit of a race between the three. I think Microsoft definitely does have the lead, but from returns perspective, or from generating kind of long-term returns for us, we see a lot more opportunity in the mid-cap space. So I think while these like mega caps, I think they're going to do fine during the cycle. I think there is a lot of opportunities for them. I think the mid-cap space is really been valued here, because these companies didn't necessarily have as much resources to weather the storm. Some are going to really drop off, but the ones that will survive and that are cash flow positive and are investing in their businesses are coming up with some pretty innovative things here. So I think there is going to be a lot of changes, and I think a lot of value will accrue in this in the mid-cap space, which is what we're really focused on.
Is that purely within the AI space, or is that more sort of ancillary stuff like the snowflakes and the Datadogs, or more the cybersecurity space, the Zscalers, etc.?
Across the board, I would say. So yeah, like definitely on the infrastructure side, we're seeing like the snowflakes, the Datadogs, and then cybersecurity side as well. And there's some overlap as well, right? Like the Datadogs or the ops applications are moving towards cybersecurity. So it's a space that's in a pretty big change. And the interesting thing is that this space had really not matured even prior to AI. So if you look at cloud security, for example, that's a whole new area, even outside of AI, that is pretty rapidly growing. So now include the growth from all these applications that are likely to be built on the cloud. You have a whole new space opening up. So I think there is a lot. So that's where we're basically finding most of the opportunities. Is going to be companies that provide tools, and whether it's on the security side or making it easy for you to use AI. That's basically the biggest opportunity set.
It definitely seems that especially the security side was something which had a lot of focus, but really since AI has taken front and center stage, it's had very little discussion in the market.
Yeah, and very interestingly, I think you're spot on. Very interestingly, cybersecurity is going to benefit from AI in two ways. First, the cyber attacks are going to become much more sophisticated, right? So even though a lot of cybersecurity that we use today is already AI-based, it wasn't Gen AI based, but was AI-based. A lot of these new attacks that are going to be coming are really going to be able to bypass whatever we were using before. So you're really going to need a whole wave of innovation to be able to fend off these more sophisticated attacks. And then on the other side, which I think is even going to be larger, is that as you have this data take such a critical role, for whether it's for model training or whether it's for inferencing, you're really going to need to secure this data and figure out how you're going to be building your products in a secure way. So I think those are two kind of separate areas. One is cybersecurity kind of being the driver of demand, or AI being the driver of demand. The other one being like you're needing cybersecurity as a tool. But I think both of those are really going to come together, and we're not seeing it in the numbers yet because as I mentioned, we are going through a little bit of a down cycle in the US. with cloud spending and optimizations and companies cutting their budgets. And a lot of the tools that they're introducing today are kind of growing from a very small base. So they're contributing a few hundred basis points to growth, but these companies are growing at 30%, right? So they're really not making like a meaningful difference for them. But as they gain scale, they are going to become a lot more meaningful contributors to growth.
NVIDIA, you were talking before about the arms race and the Mag 7 all needing significant computing power in order to deliver the tools that they are already making available to the public. And NVIDIA is the benefactor of that demand as the GPU provider. How do you see its growth profile from here? And I mean, it was notable that your largest investment, I think you've got 14% currently of the ETF invested in NVIDIA. And so you must believe the story is very real. How do you see it playing out?
So I think NVIDIA has a pretty significant lead compared to everybody else that is trying to enter the market. And this is because they didn't just come up with these tools. It's something they've been working on for the past 10 plus years. So it's a technology that they know very well from the graphic side that they were able to transform to be able to use for other applications like generative AI. And what they've been able to do over time is build this CUDA architecture with a lot of free frameworks that sit on top of the infrastructure that are just very easy for companies to use. Just to give you a sense, I was talking to GE 5 years ago, and they were going through like a lot of cash flow problems, and the company was struggling. They were like, "Oh, we came up." I talked to their healthcare team, and they're like, "Oh, we have this AI technology that can scan radiology images." And I'm like, "How did you even come up with this? Like, it sounds expensive, and you have no money, right?" And then turns out it's really something that you can just use a framework or a library that NVIDIA has already pre-built and apply to this data or these images. So it's a tool that a lot of companies were using even before Gen AI, these frameworks that are readily available. So it's really provides the company with a pretty significant moat. And then on top of that, I think, so that's something that I think by now most investors know or appreciate in terms of like the width of applications for NVIDIA's product. What I think people don't realize today is how much they've invested in software applications that help you optimize the use of the GPUs. So that's really like where we're reaching the limitations today. It's like, okay, you came up with the GPU, but now like, how are we going to advance? Like, how are we going to get more out of this? And a lot of it is like, okay, well, now let's make it into a system or a rack and connect a bunch of GPUs. And that's really like these new products that they're introducing, like the Blackwell or the H100 is basically a bunch of GPUs connected together. So the key here is how you're connecting them and how you're optimizing their performance. And this is something that like they've been really working on for several years, that it's not really just copying a chip. It's really a whole system that you need to kind of replicate and build the know-how of. So I think they have a pretty strong moat. And a lot of companies, like you'll see, like even Elon Musk about a year ago, they were like, "Oh, the Dojo is going to be a competitor to the H100." And then they took delivery of the first H100. So they were like, "Oh, wait a minute, this is going to be a far, like this Dojo thing. It's not really, it's going to be maybe something in the long term that can compete with this H100. So it's just something that's been in the works for a very long time. That it's very difficult for somebody to replicate. Now, there is going to be a lot of competition. I think the hyperscalers have to invest in their own, like building their own products, and we see opportunities on that side as well. Because when they invest, they don't do it on their own. They partner with somebody else that does the silicon for them. So would be companies like Marvell. So I think those will capture market share. I think AMD has a pretty interesting approach, and they're probably the second one in line that can keep up with the pace of innovation. So I think there's going to be new entrants. I don't think it's going to be a winner takes all market, but NVIDIA has such a significant lead right now that I think they're going to be able to maintain very high market share. And if you look at what the street is assuming, I think the numbers for this year are already pretty have increased pretty significantly. But if you look in the out years, I think analysts are assuming something like 20% CAGR. If you look at the prior data center cycle, the data center segment grew at a 40% CAGR, and this was without even having Gen AI, right? So I think the estimates look pretty conservative in two plus years out, which is what's going to be providing support for the stock at these valuations.
In terms of the, I suppose the structure, is there a market for, there's a group of clients and there's a group of maybe the hyperscalers who need the H100 and the speed that comes with that. If, say, AMD's product is half as fast but maybe less than half the price, is there a market and a solution space for that sort of product as well, or do you need the Ferrari of the GPUs?
So I think some people are going to need the Ferrari, right? So there's going to be always demand for the new products that are coming out. The interesting thing is that the newer products provide better performance at a better price. So it's almost like if you're investing, like you'd always want to get the newer product. It's kind of like very similar to getting a new computer, basically, right? Where like the next one you're getting is going to be a little more expensive, but will have a lot more functionality. So in general, there is going to be, like, for example, for inference, you can use less powerful or less performant solutions. So you don't necessarily need the Ferrari, if you will. But I think for many applications, you do need actually the best products. And that is how you're going to be able to differentiate yourself. So I think there is market for both, but it is going to be very important for the next player like AMD to be able to keep up with the level of innovation, because at the end of the day, if they're not able to deliver the same performance at an attractive price, they're not really going to be able to win the market. But for now, I think their products have been actually pretty good with a lag, and also without having all these frameworks and infrastructure on top of it. So if you're a customer of AMD, you need to be open to or willing to build that out yourself.
You talked about cybersecurity, and we've obviously touched on AI themes coming through your portfolio. Cloud computing is another theme you see with your largest holding and sort of the net theme being Sentinel. Could you take us through why you think there's still opportunity there, given that it's existed for a good number of years now?
Yeah, absolutely. So basically what's going on right now in the cloud space is that a lot of these companies like Microsoft, with Azure, right, AWS, they have like launched their businesses, and now they're like where most enterprises will, like what most enterprises will use. So what's developed over the past 5 years is tools and applications that sit on top of these infrastructures, right, that help you use those products better. And over the past 2 years, cloud computing has gone to a pretty significant down cycle. So companies were optimizing their budgets, they were cutting their cloud bills. I think they were being like reckless with spending while things were really good. And then it came time where they were like, okay, well, we need to kind of tighten our belts here and figure out like what we're needing, what we're using. So we just went through that down cycle, and 4Q of last year was the first time that we started hearing of things stabilizing. So we see a pretty significant cyclical inflection for the cloud vendors like Azure, Microsoft, AWS from Amazon. So we see a pretty significant cyclical inflection. Now, on top of the cyclical inflection, there is AI, right? So a lot of the new tools that are going to be built are going to be built in the cloud. And what we haven't seen just yet is this trickle down to some of these mid-cap companies like a Snowflake that provide services to to the cloud vendors. Or Datadog is another good example where the company just reported earnings. They kind of came in line with expectations, which people thought was disappointing because they were like, well, usually you grow at 2 times the rate of Amazon. So Amazon grew 17%. So people were like, okay, why can't you grow 35? And the explanation was that Amazon is growing right now because they've just invested in AI and they're selling this hardware as a service. And then the next layer is going to be when companies are going to be building these applications, and that's when they're going to need somebody like a Datadog. So it's really something that's going to come like with a bit of a delay in the cycle. But a lot of these tools are just really needed for you to build applications. So I think it's more a question of when rather than if they're needed.
Okay. You've got, when you look at your fund, there's a bunch of themes. So you've got enterprise digitization, automation and robotics, artificial intelligence, of course, environmental focus and decarbonization, phonetics and additive manufacturing, and space exploration. Which of those themes do you think is the sort of the unloved one, the one that's going to come through over the next few years, other than AI? That, you know, is space exploration going to be it, or which is the one that most excites you the most?
Well, it's interesting the way we kind of like work with those themes, because unlike other funds that will look for exposures to themes, what we do is we cover a universe of, let's say, 120 companies, and we try to figure out, based on what's happening with these companies, what are going to be the interesting themes to invest in, right? So a lot of these themes are kind of high level, and we're going to know what's interesting when we see companies building products at scale, right? So we really are looking for scale and sustainable business models rather than just an exposure, because space sounds very interesting, right? But if you dig deeper, there are not that many companies that are providing great returns for shareholders by investing in space exploration. So I think all 6 themes at some point over the next 20, 30 years are going to have their moment. But it's really going to be finding the time where there are companies that are selling products at very attractive returns. So we don't necessarily think of it as like, oh, which one is going to be next. We're really looking for it. Okay, well, what's happening today, and where the opportunities today. But a lot of them, like decarbonization, will have like, we got totally overhyped. People were like throwing dollars on like themes that like ESG based metrics that didn't really make sense, and a lot of these companies got driven to valuation levels that just didn't make any sense based on fundamentals, and that's reset now. So there's a lot of opportunities in that space as well. So for us, it's really more finding like the right entry point for specific opportunities rather than kind of looking for exposure to a theme. And it's very similar with AI, right? We were able to see the AI trend early, but we weren't like, oh, let's just buy like a basket of 10 AI companies. We really drilled deeper into it, and we're like, okay, well, here's NVIDIA. They're really providing the core infrastructure. Let's see who else will benefit. So that's kind of how we built. And we're like, okay, well, maybe it's going to be like the build out of the data centers, right? So that's kind of how we find the opportunities rather than from like a thematic high level.
And if through that sort of process you find opportunities in quite a different tangent, say for example, electricity, obviously AI is very electricity dependent, would you be willing to go down that and sort of outside of the pure tech space?
Absolutely. Yeah, absolutely. So we do own IPPs in our fund. So this would be the independent power producers in the US. They're a recent idea for us as of this year. We didn't have any exposure to this space last year. Same thing with copper mining. It's another area that we see it as a tangential play. These areas are not going to be like 30+% of the fund, right? So we're trying to stay balanced between the different opportunities that we see. But we do see like the power markets in the US have been really like muted for the past 20 years, and with a lot of the electrification trends, the demand side has started improving. And then even this is outside of AI, right? The demand side has started to improve. And then what's been happening with a lot of the coal generation that came offline has been replaced with renewables. So now a lot of times, like when you have peak demand, you really are not able to meet it, and prices really spike. So these trends, even outside of AI, just started improving kind of over the past year or so. And then on top of that, layer in the data center demand that is going to be required to power a lot of these data centers and these processes, this accelerated computing wave. It's going to create pretty attractive dynamics for the power market. So in the US, basically, there's regulated utilities, and then there is IPPs, which are independent power producers, and really the value is going to be more on the alpha is going to be more on the IPP side, because they're able to capture when there are spikes or when there are increases in prices. They're going to be able to capture value. So we like a company called Constellation Energy. They own the biggest portfolio of nuclear power plants in the US. And then we also like a company called NRG. They have pretty significant exposure to the Texas power generation market. So that market has pretty attractive dynamics. So yeah, absolutely. We try to find across the value chain, we're sector agnostic. Over time, it does end up being a lot of our investments will be in the technology space. That's because that's where there is the most change. But wherever we see opportunities, we will go and do the work.
There's a lot. It's very US centric, though, isn't it? Where you focus your investment, and where you deploy your capital, and obviously where you're focusing your research. And which brings about the question: why is the US so, in your opinion, such the sort of epicenter of innovation in this space? And what is it about it that culturally or other, regulation that drives that forward?
Well, I think for us specifically, we do a lot of boots on the ground research, and it's just easier from access perspective to be able to meet with these companies and talk to them and really gain like real time access. So that's one area that's not necessarily relevant to the market, but the market itself is very innovation friendly. It's a pretty open market. You can there is access to funding. Companies can really gain like if you have a good product, there is no shortage of funds. And then on the flip side, the regulatory environment is pretty favorable. It's not as good as it used to be, but it's definitely gotten a little more complex. But it's still a pretty good regulatory framework where I think like people that have good ideas can like get them through in a pretty efficient way. So I'd say like definitely the regulatory framework and the fact that it attracts a lot of international talent is definitely why we're seeing a lot of innovation. I do feel like it's going to broaden out to other countries that do have favorable dynamics. But for us, to my prior point, it's just easier to because we have a very like narrow niche focus. It's just easier to do the work domestically.
Ivana, thank you very much for joining us. I'm sure, wish you all the best for your fund and really appreciate you taking the time. It's been a fascinating conversation, and I hope you have a great week.
Thank you.
See you later.
Thanks.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.